Hi, I'm Jesse Hooton. I'm a CFA charter holder. Wanted to review a name in the AI space today, Supermicro. Supermicro, basically, their business involves providing servers for data centers right now with a backlog of 39 billion in orders. Supermicro has also positioned themselves around a proprietary liquid cooling system, which is really important in the AI space. As of right now, 60% of their business is based in the US, but they are expanding into other markets. Reviewing some multiples that I find valuable in regards to Supermicro, we'll see a trend over the last 3 years. Enterprise value to EBITDA, you'll see over 2023, 2024, and 2025 across the EV multiples, EV to EBITDA, EV to EBIT. The range that you'll see is sort of more in line with the broader market. It's more on the rightmost column. The last 12 months of earnings brings that ratio significantly below the trend over the last 3 years, suggesting the company relative to its history is actually being traded at a more, I guess you could call it cheaper price, which is what we like to see. I particularly look to EBITDA multiples, as EBITDA takes earnings before depreciation and amortization is taken into consideration. The reason I like that is depreciation and amortization can be volatile. They can be inconsistent from one company to the next. So in terms of comparing one company on a relative basis, I find it valuable to take the EBITDA figure, but the EBIT, earnings before interest and taxes, a proxy for operating income, also valuable. At the bottom, we'll see price to earnings, both last 12 months and next 12 months. Similar trend, the last 12 months, as of today, dramatically lower as a multiple than its 3-year trend up until the end of fiscal year 2025. So on a valuation perspective, it seems to be trending in a way that is favorable for a prospective investor and below its trend, historically speaking. Moving down, we're looking to interest coverage. How efficiently is it covering its debt expense? We'll see a few different metrics of earnings and how it's covering those expenses. EBIT, EBITDA again to interest expense. So what we like to see, contrary to the valuation multiples we just looked at, we like to see a high multiple, meaning that there's more than enough earnings to cover interest expense. We do see a bit of an erosion from 2023 to 2025 on their interest coverage. And in particular, the last 12 months, we're looking at dramatically lower coverage ratio than its historical trend. So that's going to suggest the company's taking on more debt. It's more leveraged, which suggests a riskier proposition to investors, which should play into the discount rate and the amount of risk that we have to consider in regards to this company. And then lastly here, similar to what we just looked at in terms of interest coverage, you'll see total debt to equity is dramatically higher from 2023 through to end of fiscal year 2025. And then as of today, the last 12 months, sitting at 120%. So there's been an explosion in the debt level for this company relative to their equity, relative to their capital. It's also increased across the different leverage metrics that we have here. So that all plays into the amount of risk the company is taking on and what discount rate we might consider reasonable for a company with this debt level. Compiled here a basket of comparable companies. You'll see this is for price to earnings last 12 months across the S&P 500, HPE, HPQ, NTAP, Just a basket of comparable companies, comparing their PE in this instance. You'll notice across the top 16.4 for SMC last 12 months. Apart from HPQ, that's on the lower end according to this comparables basket. It did spike, SMCI being the blue, Supermicro being the blue. It spiked just middle of 2024 and came back down as of today. And then we move to, let's go to the next 12 months, price to earnings. This will be the comparables basket. So compared to the S&P, it's dramatically lower on a next 12 months PE basis. Again, the only company being lower, HPQ, for this comparables. So all suggesting that if anything, the company on a relative basis is on the undervalued side. Looking at a couple EV to EBITDA multiples, again, I like the EV to EBITDA in particular because it controls for depreciation and amortization, which can be unreliable figures at times. On a last 12-month EV to EBITDA basis, we're looking at SMCI being on the higher end, still below the S&P in this case. So do with that information as you will. On the enterprise value, not looking as favorable, as undervalued as it was on the PE basis. And then lastly, looking at a next 12-month EV to EBITDA, things are looking a lot better on a forward-looking basis for SMCI compared to the last 12 months, suggesting that there's a favorable outlook for EBITDA growth on a comparables basis. So that's what we'd like to see. The EBITDA is looking better on a next 12-month basis than on a last 12-month basis. Similar, the PE to growth, that's going to be the last ratio we take a look at. You'll see HPQ kind of going wildly here. We like to see a lower multiple. Essentially how this works is the PE multiple divided by the expected growth rate on a next 12-month basis in earnings. And we're seeing 0.35. That's a low multiple for price to earnings to growth, suggesting that not only was the PE relatively low, but compared to their growth expectation, they're also on the lower end. So these are all positive things to see from an investment standpoint. On to a few tables that I've prepared for the company, starting with gross margin. Noticeably, revenue from 2021 to 2025 has exploded to, these are all in thousands of US dollars, 21.9 billion in 2025. That said, cost of goods sold, so the input costs going into this revenue, has expanded even more dramatically, with the gross margin declining from 15% to 11%. That's in large part due to increasing input costs from things like GPUs, NVIDIA GPUs, as well as their advanced cooling system, which have proven to be expensive components. This brings us to operating margin, spiking in 2024 at just over 8%, then declining to 5.7%, which brings us back to our previous slide with the cost of goods sold, manufacturing costs outpacing the increase in revenue. That's also trickling over into operating margin. SMCI's internal day-to-day operations are highly efficient, requiring very little additional corporate overhead to manage a massive spike in sales volume. However, with cost of goods sold taking 90 cents for every dollar coming in, it's difficult to maintain operating margin growth. Unpredictability would define this slide for me. Free cash flow margin going from 2% to -9%, to +9%, then crashing to -17%, then back up to a strong 7% in 2025. Because of the dramatic decline in 2024, I found it difficult to actually make a free cash flow to equity discounted cash flow valuation for this company, because the average of the last 10 years free cash flow to equity because of 2024 is actually negative. However, it did rebound dramatically in 2025 at 1.5 billion. So going forward, using that as a base, it's pretty strong. But obviously some volatility in this metric. The massive AI build out in large part coming into play and impacting the steadiness of this metric. Over to return on assets for Supermicro. We have an explosion in the total asset base for this company from 2.2 billion in 2021 to 14 billion in 2025. Again, the AI craze, AI build out contributing to that. Net income up until 2024 easily keeping pace with that increase in total assets, but dropping off in 2025. Return on assets dropping to 8.8% in the last fiscal year. And then down to our return on equity metric, but decomposed across profit margin, financial leverage, and asset turnover. What we like to see with return on equity decomposed like this, seeing a tight range for financial leverage in the middle, suggests that the growth in return on equity isn't coming from is not coming from the leverage that the company is taking on first and foremost, but rather more core metrics such as profit margin and asset turnover, operational metrics, which from 2021 to 2025 we are seeing an increase in both of those as far as return on equity. Okay, on to receivables turnover. Back in 2021, 8.2. For this metric, we like seeing a higher number, indicating that the receivables we have on our books are, we're turning it over, we're collecting cash for our products and services on a faster basis when it's a high turnover rate. 2021 to 2024 receivables turnover dropped to 7.72 in an effort to support their significant sales expansion. However, 2025 there was a dramatic improvement on this metric, receivables turnover increasing to the highest over the last 5 years, despite revenue increasing 7 billion. Receivables actually decreased from 2.74 billion to 2.2 billion, which is what we like to see in terms of a cash integrity standpoint. This is connected to the days sales outstanding, essentially with a higher receivables turnover ratio. It means we're waiting, we don't have to wait as long for cash to come into our pocket. Essentially 2025, the days that sales were left outstanding, that we're left waiting for sales, services, etc. to be paid for, 41 days. That's down from a high of 51 in 2023. Unlike my previous few videos, I actually didn't do a discounted cash flow for Supermicro. What I do when I create a discounted cash flow is I take the average of the last 10 years free cash flow to equity, which is a conservative assumption, taking the average of the last 10 years, especially for a high growth company like Supermicro. The last 10 years likely going to look nothing like the next 10 years or the future for this company. But the average of the last 10 years for this company was actually negative due to the negative 2.4 billion free cash flow to equity in 2024. What I will say, taking the 2025's 1.1 $1.15 billion in free cash flow to equity. If you take that as a baseline number going forward, I mean, if you look at the price to equity, the PEG ratio, price to earnings to growth ratio, the implied growth for the next year is 26%, which would likely show up in free cash flow to equity in terms of growth, one way or another. But if you take 2025 as a baseline and assume zero growth in that figure for the next 7 years, and then 5% into perpetuity going forward, with a discount rate of, let's say, 10% in my calculation, that is roughly what the market is pricing in, with the current stock price hovering around $28. So if you are anticipating dramatic growth over the next 7 years and into the future, which is what is suggested by most analyst estimates, and the PEG ratio that we reviewed earlier, then it could suggest this company is well positioned for growth into the future, and that the current price of around $28 is a good entry point. And for that reason, I would place a buy for this company. Again, this is not financial advice. These are all my opinions. But things are looking pretty good for this company, based on the relative valuation metrics and some assumptions as to the growth going into the future for the free cash flow to equity. Thanks for watching, and I'll see you soon.